The American housing market just hit a wall that hasn't been touched in 20 years. We are officially in the Great Housing Reset right now. 47 out of the top 50 U.S. cities are seeing prices weaken for the first time since 2011. National price growth is projected to be negative, but if you're waiting for a 2008-style crash, you're missing the real story. This isn't a collapse, it's a correction of affordability. Today, I'm going to mentor you through the data at the shifting market. We will also look at why the current system of long-term lending is failing the average family. Let's get into the math. Why is this happening now? It's a simple math problem that reveals the flaws in the current borrowing system. At today's median home price of $398,000, a conventional payment is nearly $2,000, but once you add taxes, insurance, and maintenance, you're looking at $2,500 or more to qualify for this safely. A family needs to earn $106,000 a year. The average American family is currently $23,000 short of that goal. This isn't just a bad market, it's a mathematically impossible market for most. Here is a rule for our channel: never compromise your financial peace for a piece of real estate. High-cost borrowing is not just a financial burden. It is a weight on your future that we must avoid. Millions of buyers are being priced out every month because of these rising financing costs. That is exactly why the inventory is starting to pile up. Most people think the housing market is just about bank rates. It's actually about global resources like oil and the raw cost of living. When energy prices stay high, it pushes up the cost of everything we touch. This affects the yields that institutions use to set their high-cost financing terms. But there's a second hit: construction cost. Aluminum is up 39% this year and steel is up 20%. Builders aren't just being greedy, their costs are exploding. This is why you see a strange split in the market. Existing homes are sitting empty because they're too expensive to finance with traditional debt. But new homes aren't getting cheaper because they're too expensive to build. This stagflation in housing is the core of the 2026 reset. Now, let's talk about where the real opportunities are to build wealth ethically. Not all zip codes are created equal. If you are looking at condos, especially in Florida, proceed with extreme caution. There are 83% more condos listed right now than there are buyers. Skyrocketing fees and insurance premiums are crushing demand. Austin is down nearly 26% from its peak. Oakland is down 9% and Dallas is down 4%. These markets overextended, and now the bubble is popping. But look at Milwaukee, up 10%, or Delaware, up over 6%. These markets are growing because they are affordability refuges. People are migrating to where they can actually live without drowning in debt. As a mentor, my advice is to follow the real value, not the predatory hype. The government is currently looking at for major fixes. You need to know these because they will dictate the market in 2027. First, the $200 billion mortgage buyouts. The government tried to lower costs with cash, but it failed in 3 days. You cannot solve a massive crisis by fueling more high-interest lending. Second, banning institutional investors. While it sounds good, big corporations own less than 1% of single-family homes. This is mostly political talk, not a real solution for families. Third, portable mortgages. This would allow people to move their old contracts to new houses. While this helps some, it still keeps people trapped in a cycle of borrowing. Fourth, building on federal land. The government wants to use land near cities for affordable housing. This is a long-term play, but it's a real way to increase supply through direct ownership. So, what is the smart equity move for you right now? If you have a 10-year outlook, look for builder incentives. Many builders are offering 14% off the total price just to move. Inventory. A direct price discount is a clean, transparent way to save money without a loan. If you don't find a deal that makes sense, do not force it. Renting and saving your wealth is a winning strategy while the market is volatile. The goal is to be a steward of your wealth, not a slave to a financial system. Invest your extra cash in asset-backed opportunities or physical trade. The era of easy debt is over. The era of smart equity has begun. Before we wrap up, I want to hear from you directly. We talked about 47 cities falling. Is yours one of them? Drop your city and the biggest price cut you've seen this week in the comments below. I'm reading every strategy and every data point you guys share. If this deep dive helped you understand the market, hit the like button and subscribe. I'm monitoring these numbers daily so you can protect your future and build real wealth. Check out my next video to keep your financial edge. I'll see you in the comments. And remember, You are the magnet.